Can you imagine the Middle East without oil? It is almost impossible, right?
The Middle East is home to nearly half of the world's proven oil reserves. For over a century, oil has shaped the political, economic, and social landscape of the region. It has enriched countries, fueled wars, funded massive infrastructure projects, and elevated some states to global geopolitical prominence. But what if the oil runs out? What happens to the economies, politics, and societies of the Middle East when this black gold disappears? Let's break it down. Oil revenues form the bedrock of many Middle Eastern economies. In countries like Saudi Arabia, Iraq, Kuwait, and the United Arab Emirates, oil and gas account for more than 70% of total government income. As of 2023, Saudi Arabia, the world's largest oil exporter, generated approximately $326 billion in oil export revenues, according to the Saudi Ministry of Finance. The oil sector represents around 40% of its GDP and over 75% of its exports. Iraq, which relies even more heavily on oil, derived over 90% of its government revenue from petroleum sales in 2022, amounting to roughly $115 billion. Kuwait's oil sector contributes around 90% of total export earnings and 90% of government revenue. The UAE, while more diversified than others, still depends on hydrocarbons for around 30% of its GDP and about 60% of state income, according to IMF data. The strategic importance of Middle Eastern oil has shaped global geopolitics. From the 1973 oil embargo to OPEC decisions that affect global markets, oil has given these countries leverage far beyond their military or population size. Saudi Arabia's leadership in OPEC allows it to influence global oil prices and, by extension, the economies of countries like the US, China, and India. Oil wealth has also funded the foreign policies of states such as Iran and Qatar. Iran has used its oil revenues to fund proxy networks across the Middle East, while Qatar leverages its energy wealth to wield soft power via global media, sports, and diplomacy. Without oil, much of this geopolitical clout would diminish. If oil were to run out tomorrow, or even if demand sharply declined due to a global shift to renewables, the immediate impact would be catastrophic for many Middle Eastern states. Government budgets, heavily reliant on oil exports, would implode. For example, in Saudi Arabia, where public sector salaries are largely funded by oil money, there would be massive fiscal deficits. Public services like healthcare, education, and infrastructure would suffer. Iraq would face an even worse scenario. As a country already grappling with instability and corruption, the collapse of oil revenues would likely deepen poverty and fuel internal unrest. In Libya, where over 95% of export revenues come from oil, the impact could lead to a complete breakdown of government authority and escalate tribal and militia conflicts. Even relatively stable states like the UAE would feel the pinch. Their sovereign wealth funds, such as the Abu Dhabi Investment Authority with assets over $850 billion, might cushion the blow for a time. But without sustainable revenue streams, these countries would be forced into deep structural reforms. Many Gulf countries rely heavily on expatriate labor. For example, more than 80% of the UAE's population is made up of foreign workers, most of whom are employed in construction, hospitality, or domestic work, industries indirectly funded by oil wealth. As government and private sector revenues dry up, these workers would likely be laid off en masse. This could trigger a reverse migration crisis, sending millions back to South Asia, Africa, and Southeast Asia. On the other hand, local populations, many of whom are employed in well-paying public sector jobs, would face job cuts or salary reductions. In countries like Oman and Bahrain, where unemployment is already a pressing issue among youth, the situation could become explosive. In many Middle Eastern monarchies, the social contract is built on the distribution of oil wealth in exchange for political passivity. Citizens enjoy subsidies, free education and healthcare, and little to no taxes. But in a post-oil future, this model becomes unsustainable. Removing subsidies, as seen in Saudi Arabia's recent austerity measures, has already sparked discontent. If governments can no longer provide the welfare benefits that citizens expect, they may face increasing demands for political participation or even democratization. In more authoritarian systems, this could lead to repression, unrest, or regime instability. Many Middle Eastern countries are well aware of the ticking clock. Saudi Arabia's Vision 2030 is the most ambitious attempt at economic diversification in the region's history. Launched by Crown Prince Mohammed bin Salman, the plan aims to reduce the kingdom's dependence on oil by investing in tourism, entertainment, and renewable energy. Projects like NEOM, a futuristic city in the desert, and major investments in green hydrogen are designed to create new industries and jobs. The UAE has also been active in this space, becoming a hub for finance, logistics, and aviation. For example, Dubai now generates most of its GDP from non-oil sectors. But diversification is easier said than done. These initiatives require time, human capital, and stable political environments. Moreover, many of these economies still face the paradox of needing high oil prices to fund post-oil futures. On the other hand, Iran has already experienced a taste of life with limited oil revenue under heavy US sanctions. In 2022, Iran's oil exports dropped to less than half of pre-sanction levels, causing inflation to spike and the currency to devalue. The Iranian government has attempted to pivot toward non-oil exports, including mining, agriculture, and manufacturing, but with limited success. Still, Iran possesses a large population of 88 million, a developed industrial base, and vast reserves of natural gas. If it can resolve its international disputes and open up to global markets, it may adapt better than some Gulf monarchies. However, the regime's survival depends in part on oil revenues to fund military spending and domestic subsidies, so the risks are significant. If the oil economy collapses, the ripple effects will not be confined to the Middle East. Europe, which has long been a destination for Middle Eastern migrants, could face new waves of economic refugees. A destabilized Middle East could also embolden extremist groups seeking to exploit unemployment and disillusionment. Already fragile countries like Yemen, Syria, and Lebanon, though not major oil producers themselves, would be further destabilized by the regional economic crash. Remittances and aid from wealthier Gulf nations would dry up, worsening humanitarian crises. However, some countries may weather the storm better than others. The United Arab Emirates, with its diversified economy and massive sovereign wealth funds, could maintain a degree of stability. Qatar, thanks to its vast natural gas reserves and small population, would also fare relatively well. Oman and Bahrain, with limited reserves and smaller financial buffers, may struggle more. Countries like Jordan and Egypt, though not major oil exporters, depend on Gulf aid and remittances from citizens working in the Gulf. A collapse in oil prices or production could lead to economic shocks for these countries as well. The Middle East stands at a critical juncture. The region can no longer afford to rely solely on oil as its lifeline. As the world shifts to cleaner energy sources and demand for fossil fuels declines, Middle Eastern nations must adapt or face severe consequences. If oil runs out before diversification efforts take hold, the region could face economic collapse, mass unemployment, political unrest, and rising authoritarianism. But if leaders take decisive forward-looking action, the Middle East has the resources, capital, and strategic location to reinvent itself. The post-oil era is approaching. Will the Middle East be ready?